You got paid last Friday. Maybe it was $8,000. Maybe it was $12,000. Maybe it was more. And before you spent a single dollar, you did what you were taught to do. You moved a portion, maybe $500, maybe $1,500 into your savings account. High yield, probably. You've been responsible about that. You felt good. Briefly. Here's what I want you to sit with for the next 20 minutes. That transfer, the one that felt like progress, is mathematically guaranteed to make you poorer in real terms. Not because of what you might spend later. Not because of risk or market swings or some future crisis. Because of how the account was designed before you opened it. I'm going to show you exactly how that works. And I'm going to show you two people who started in identical financial positions, made one different decision, and trace exactly what happened to both of them over the next 8 years. The belief behind this isn't complicated. You've heard it since childhood. Spend less than you earn. Save the difference. Put it somewhere safe. The word safe matters here. Savings accounts are named for what they're supposed to do. They save. They protect. They preserve what you've accumulated against the friction of daily life. A high-yield savings account, the modern responsible version, pays you to hold your money there. 2, 3, sometimes 4%. That's better than nothing. That's better than a checking account. That's better than stuffing cash in a mattress. The logic is airtight. You have money. You don't need it immediately. You put it somewhere that keeps it safe and pays you a small return while it waits. This is what financially responsible adults do. This is what every personal finance article has told you to do. This is what your parents did. The belief is so deeply embedded that questioning it feels irresponsible. It feels like the kind of thing that gets said by people who don't actually save anything, who use the complexity of finance as an excuse not to do the simple, obvious, correct thing. You save. You put it in a safe account. It stays there until you need it. That's the belief. And for most people, it remains unexamined for decades. Let me give you one number. In 2022, the average savings account at major banks in the United States, JP Morgan Chase, Bank of America, U.S. Bank, paid between 0.01% and 0.06% annually. Even the best high-yield savings accounts, offered by online-only institutions, were paying between 0.5% and 1.5%. That same year, inflation ran at 8.0%, confirmed by the U.S. Bureau of Labor Statistics. The gap between what your savings account paid you and what inflation removed from your purchasing power was somewhere between 6.5% and 7.5%. Not a rounding error, not a minor inconvenience. 6 to 7% per year, compounding, moving in the wrong direction. Some of you are thinking, that was 2022. That was an anomaly. Rates are higher now. So let's use a more generous number. As of May 2026, the best high-yield savings accounts pay between 4.0% annually. The national average across all savings accounts, per FDIC data, sits at 0.38%. The average high-yield savings account pays around 1.59%, at approximately 3.8% as of April 2026, per the Bureau of Labor Statistics. Take the best available rate, 4.5%, being generous. Subtract 3.8% inflation, you have 0.7% real return before taxes. If your household income puts you in the 24% federal bracket, which starts at $103,351.25, that 4.44% becomes approximately 3.42% after federal tax. Against 3.8% inflation, you're now at negative 0.38% real return. Your safe account is losing, not catastrophically, not visibly, not in a way that shows up on any statement. The number in your account is growing. The purchasing power of that number is shrinking. And this is not a bug in the system. The mechanism operates through the gap between two rates that most people have never compared side by side. The first rate, what the bank pays you to hold your money. The savings rate, set by the bank, influenced by the federal funds rate, calibrated to be competitive enough to attract deposits without being so high that it costs the bank meaningful money to hold them. The second rate, what inflation removes from the purchasing power of your money each year, set by macroeconomic forces, heavily influenced by monetary policy and not neutral. Mild, persistent inflation is explicit policy. The Federal Reserve stated long-term inflation target is 2%, as measured by the Personal Consumption Expenditures Price Index formally adopted in January 2012, published in the FOMC's Statement on Longer-Run Goals and Monetary Policy Strategy. The European Central Bank holds the same target. This is intentional. Mild inflation benefits debtors, including sovereign governments that carry large national debts. It erodes the real value of money owed over time. It discourages hoarding. It encourages spending and investment. The people who designed the system are not hiding this. The Fed publishes it. It's just not the part of the briefing that gets covered in personal finance content. Before the era of central banking and fiat currency, savings had a different relationship to value. The move away from commodity-backed money gave governments and central banks the ability to manage inflation as a tool. This transition happened gradually across the 20th century. By the time it was complete, the savings account had already been culturally established as the responsible, safe choice. The mechanism changed. The cultural message did not. Banks accept your deposit. They lend those deposits out at higher rates: mortgages, auto loans, credit cards. The spread between what they pay you and what they charge borrowers is called the net interest margin. It is how banks generate revenue from your savings. Your savings account is not a vault. It is a funding mechanism. You are functionally a cheap source of capital for your bank's lending operations. The rate they pay you is not a reward. It is the minimum required to keep you from moving your money elsewhere. Three parties benefit from this structure. Banks, through the spread between deposit rates and lending rates. The federal government, through the gradual erosion of debt obligations denominated in nominal dollars. And asset owners, people who hold real estate, equities, commodities, because inflation erodes cash, but often inflates the value of assets. The saver, who holds primarily cash, absorbs the cost that the other three avoid. No single person designed this. No meeting was called to decide it. The structure was built over decades, piece by piece, by rational actors, following rational incentives. The savings account sits at the bottom of that structure. Hold that thought. Now meet Marcus and Diana. Marcus Reeves is 41, senior operations manager at a logistics company. Household income $185,000 combined with his spouse. Take home after taxes and benefits, approximately $10,800 per month. 2 kids, ages 9 and 12. Fixed costs around $18,400 per month. Discretionary margin, $2,400 per month. His emotional state is what you might call discipline satisfaction. Marcus is proud of his financial habits. Diana Osi is also 41, director of product at a mid-sized tech company. Household income $185,000. Same take-home, approximately $10,800 per month. 2 kids, ages 10, 11. Fixed costs around $8,400 per month. Discretionary margin, $24 per month. Her emotional state is restless uncertainty. Diana is not sure her financial habits are working. Both of them have $68,000 in savings. Both are adding $1,000 per month. Both consider this money their financial foundation, the thing that lets them sleep at night. Everything about them is identical, except one decision. Marcus keeps his $68,000 in a high-yield savings account paying 4.2% annually. He finds comfort in its stability. He adds $1,000 per month. He does not touch it. Diana moves $50,000 of the $68,000 into a low-cost, diversified index fund tracking the S&P 500. She keeps $18,000 in liquid savings, roughly 2 months of fixed costs. She continues adding $1 UDOT per month. Split, $300 to liquid savings, $700 to the index account. The S&P 500 has returned approximately 10% annually on average over the last 30 years. That is a long-term historical average, not a guarantee of future returns. Diana knows. She practiced dosis PC Mer $68 grows to approximately 60 cents at 4.2% plus 20 titions upcent. Total, approximately 72 monthly featuring douche against 3.8% inflation. Purchasing power erosion on the full balance runs approximately real value, approximately $7,900. Diana's $18,000 to liquid savings earns 4.2%, reaching approximately $18,756. Her $50,000 in the index using a conservative 8% for year 1 reaches approximately $54,000, plus split contributions over the year. Nominal total $84,750, real value approximately $83,008. The gap at year 1 is roughly $3,900 in Diana's favor. Marcus shrugs. The market could drop. He is not worried. Year 3. Marcus, nominal savings approximately $113,000. Real purchasing power approximately $99,500. Diana, liquid savings approximately $26,000. Index account approximately $82,000. Nominal total approximately $108,000. Both feel roughly similar in terms of financial stability. Neither of them is thinking about the other. Year 5. Something happens. Marcus's company restructures. He takes a lateral move, same salary, but the bonus he was expecting doesn't come through. $18,000 in projected income doesn't arrive. He draws $14,000 from his account to cover a bathroom renovation he'd already committed to and a tuition payment for his older kid's private school entrance prep. His savings drop to approximately $108,000 nominal. Diana's company goes through a rough quarter. She also loses objected bonus of approximately $15,000. She draws from her liquid savings account $14,000. Her liquid savings drop to approximately $19,000. Her index account is at approximately $121,000. She does not touch it. Same income shock, same withdrawal amount. Different structure. Marcus absorbed the hit from the account earning below inflation. Diana absorbed it from the account built for exactly that purpose. Her growth engine was not touched. Marcus has rebuilt his savings to approximately $32,000 nominal. He is proud of this number. At 3.8% average annual inflation over 8 years, the cumulative price level has risen approximately 35%. The purchasing power of his $130,000 measured in year $1 is approximately his $97,000. He has been saving steadily for 8 years. In real terms, he is worth less than he was at the start. He is not aware of this. The number is bigger. It has always gotten bigger. Diana liquid savings at approximately $30,000. Index account approximately $168,000 based on continued contributions and a long-term average annual return of 8. Hypothetical projection based on historical S&P 500 performance, not a guarantee. Nominal total approximately $198,000. Real value adjusted for cumulative inflations approximately $146,000. The gap between Marcus and Diana at year 8, approximately $48,000 in real purchasing power. Neither of them made a high-risk decision. Neither of them is a sophisticated investor. Neither of them changed their income, their spending, or deferred discipline. Marcus followed the instructions. At year 8, Marcus's older kid gets accepted to a private university. Average tuition and fees at a 4-year private institution run approximately $43,000 funded $350 to $44,961 per year in 2025-2020's data. Total cost of attendance including room and board averages around $63,000. 2 years of that would consume his entire account. He looks at a $132,000 and does the math. The number that felt like security is, in concrete terms, enough for 1 year of one child's education. He is not angry. He is not panicking. He just sits with the question, where did it go? The answer is, it didn't go anywhere. It was already guaranteed not to arrive. Marcus does not suddenly shift strategies. Diana does not declare victory. Both of them are still in the middle of a financial life with no clear endpoint. But the structure they chose in year 1 is still running. Silently, one of them knows the mechanism is there. One of them does not. That asymmetry will compound. Marcus and Diana are one version of this. Scale it. According to Federal Reserve data via the St. Louis Fed, American households held approximately $10.85 trillion in savings deposits and other checkable deposits as of mid-2025. The FDIC reports the national average savings rate at 0.38% as of May 2026. Against an inflation rate of 3.8%, the gap between what the average saver earns and what inflation removes is approximately 3.4 percentage points per year. The hypothetical. If even 30% of that deposit base, approximately $3.25 trillion, is experiencing a real return of -1% annually, that represents roughly $32 billion in collective purchasing power erosion per year. This is a projection based on assumed rates, not a measured figure. The direction, however, does not vary. That purchasing power does not vanish into a void. It redistributes to banks through net interest margins, to asset holders through inflation-driven appreciation, to governments through the gradual erosion of debt obligations in real terms. The mechanism doesn't require a deliberate decision to harm savers. It requires a structure where the incentives of every participating institution point in the same direction. Banks profit from cheap deposits. Governments benefit from mild inflation. Asset holders gain as cash erodes. The saver, holding the one instrument that participates in none of these gains, absorbs the cost. You happen to be standing at the bottom when the design was finished. You came into this video with a definition of safe. Safe meant the number doesn't go down. Safe meant no risk of loss. Safe meant stability. You could check account on a Tuesday morning and the number would be the same as Friday or slightly higher. That definition is correct as far as it goes, but it's measuring the wrong thing. A savings account is nominally safe. The number does not go down, but purchasing power is not the same as nominal value. And a financial instrument that protects the number while eroding the value is not doing what the word safe implies. There's a different definition worth considering. Safe could mean the assets you hold are resistant to the specific forces that erode wealth. If one of those forces is inflation, and inflation reliably outpaces cash returns, then a savings account is not safe in that sense. It is comfortable. There is a difference. Comfort is the feeling of stability, the absence of visible change, the psychological ease of a number that grows in a predictable, small way. Safety is protection against the actual mechanisms that erode your financial position. These two things can look identical from the outside. They can feel identical, day to day, for years. The divergence only becomes visible over long periods, which is exactly why it persists. Marcus feels safe. Diana feels uncertain. At year 8, Marcus has less. The feeling was not the outcome. You were told to put your money. You did. The account kept its promise. The number didn't go down. The purchasing power, which is the actual resource you were trying to protect, went down anyway. The account did exactly what it was designed to do. It kept the number stable. It kept the anxiety low. It kept the money accessible and the mind quiet. What it was not designed to do, what no one ever said it would do, is protect the value of what you stored there. You read the label. You missed the mechanism. You followed the instructions perfectly. That's the problem. Your savings floor is set by math, but your spending floor, the minimum you'd feel comfortable spending in a given month, that's set by something else entirely, something outside your control. Next time, we look at who sets it.